Let us understand cash flow analysis in this session. We'll take an example to understand the importance of cash flow analysis. Let's say a company has made sales of 100 and it has incurred some expenses and it's 60 and it has a profit of 40. Now, what could be the cash balance of this company? Three possibilities are there. One, it can be less than 40. Two, it can be equal to 40. And three, it can be greater than 40. So in what scenario it can be less than 40? We'll call it as scenario 1. In scenario 1, let's say the sales what has been realized is less than what has been made. So here the company has made sales of 100, does not realized all the sales. Let's say the realization is only 50 and payment out of 60, let's say it has paid 30. So money realized is 50 and what is paid is 30, the cash balance is 20. So here the cash balance is less than profit. So this is scenario 1. And scenario 2 is cash balance is equal to profit, that need not be explained. Whereas in scenario 3 the cash balance is greater than profit. How it could be? It could happen when the company has realized most of its sales, or let's say it has realized all the sales, 100, and it has not paid some portion of expense, or let's say it has not paid anything on its expense, so nothing. So now it has a cash balance of 100 and this cash balance is greater than profits. So what I'm trying to drive here is profit is not equal to cash. Earning profit is important, and it is equally important that cash position should also be balanced. See, the balance sheet will have liabilities like capital, long-term loans, short-term loans, creditors and current liabilities, and with all these funds, long-term assets and short-term assets would be created. And with these assets, what will happen? The company will work and would try to generate income, and all those income will be captured in income statement, and it would be basically the sales and other income, and expenses have to be incurred, and finally the company would make profit or probably would end up in loss, whatever. Now look at here, all these are called raising funds. Funds have been raised for creating assets to generate sales and profit. So all the liability raising process are called raising funds, and we can call them as financing activity for cash flow analysis purpose. And look at here, the long-term assets are being created, and these activities can be called as investment activity for cash flow analysis purpose. And look at here, the short-term asset, the creditors and current liabilities. These are all called as operating activities. These are all created out of operating activities. And look at the profit, it is also created out of operating activities. So what we did here is we have identified what activity results in financing, what activity results in investment, and what activity results in operating activity. So cash flow statements also does the same. Cash flow statement will analyze the cash flow movement between operating activity, financing activity, and investment activity. So cash flow statement would give us the cash flows on how much had come from operating activity, how much from financing activity, and how much from investment activity. And it would give us what is the net cash that has been generated during the year.